Welcome to My Finance Teacher. In this video, we continue talking about ratios, and more specifically, we're going to talk about profitability and market value ratios. I would argue that these two categories are perhaps the most important for financial analysts and for investors. And for a discussion of other ratios, the liquidity, leverage, and asset management ratios, see the links down in the description. Let's start with profitability ratios. Clearly, profitability ratios show us how profitable is the firm. And as usual, we're going to use the data from our balance sheet and the income statement to calculate just a handful of ratios here. Let's stick to a simple case of 3 ratios. Our first ratio is going to be profit margin, which is the ratio of net income or the profit of a company over the sales revenue. In our particular case, the profit margin is going to be this net income, 300 millions, divided by, let's say, 2 billion, giving us a profit margin of 0.15 or 15%. Our next profitability ratio is the return on assets, which is the ratio of net income to total assets on the balance sheet. Return on assets is used pretty often, so it has its own acronym ROA, return on assets, which in our example is again equal to this 300 millions divided by the total assets of 3.6 billions and more, giving us 8.2% return on assets or 0.082. And the last ratio in this category is going to be return on equity. This is also a very common ratio to look at, so it has its own acronym ROE, return on equity. Within this category of profitability ratios, if I were to highlight only one of them, I would highlight the return on equity, which in our example is again equal to the ratio of this net income, 300 million, divided by the total equity on the right side of the balance sheet, giving us a ratio of 14.4% or 0.144. Now, briefly talking about the meanings of these ratios. The profit margin generally shows that every dollar in sales revenue generates around 15 cents in the actual after-tax profits. Return on assets shows how much each dollar in total assets generates in after-tax profits. And of course, not all of the total assets might be financed by the shareholders from their pockets. Much of the total assets might actually be financed by leverage. So for example, if you are running a $10 million company, making $1 million in profits, return on assets is 10%. But if only half of that money is financed from the pockets of the shareholders, then the return to the shareholders is double that. That's $1 million on the 5 million financed by the shareholders. Hence, a more important measurement here is the return on equity, which shows how much in after-tax profits is generated by each dollar invested into the equity of the company. Next, let's have a look at the market value ratios, which show the valuation that the market gives to the firm. So what do we mean by the market giving the valuation to the firm? What I mean by this is we are taking into account all the traders and investors that might be buying and selling the shares of the company or perhaps considering to invest into the company. All of that activity creates the value per share or some sort of a value that all of those market participants perceive in owning some part of that company. As the valuation depends on a lot of that activity from market participants, we need to introduce more data as the balance sheet and income statement are not really enough for the market value ratios. We will need a share price and the number of shares outstanding. Let's say the share price is $88 and let's say the number of shares outstanding is 33 million. And now that I'm operating with large numbers over here for number of shares outstanding, let me also consider these numbers in the balance sheet and income statements being represented in millions as well. So with everything expressed in millions, let me also express number of shares outstanding in millions as well, which allows me operating with a simpler number, let's say 33. And the first ratio we're going to look at in this category is, of course, earnings per share. This is a very common ratio discussed in a lot of investment discussions. It's often called simply EPS. And that's a ratio of net income or the profits to the number of shares outstanding. In our example, that's 300 million divided by 33 million shares outstanding. We have $9.09 in earnings per share. So that is pretty good. Of course, you want larger numbers over here, but that's not really a complete picture. If you want to evaluate your investment options with this company, you want to compare the earnings each share provides with, of course, the price of that share. It's good if the earnings are higher, but if the price is too high on the other hand, perhaps the cost of buying that share outweighs the earnings that it can generate for you. So the next important ratio to consider, that's perhaps the one I would like to highlight here, is of course price earnings ratio. That's a ratio of the share price to EPS, or the earnings per share. In our example, the share price is $88 divided by the earnings of $9.09 per share gives us a multiple of 9.68, meaning that it will require over 9.5 years in earnings to cover the share price. If that is too long or not, that's perhaps for the investor to decide. This PE, by the way, can be considerably higher, especially around stock market bubbles. And our third ratio in the category of market value ratios is the price-sales ratio, which is the ratio of share price over the sales revenue per share, which itself is the ratio of sales revenue over the number of shares outstanding. So let's have a look at an example. The share price in this case is $88 divided by the sales revenue per share, which is $2 billion over 33 million of shares outstanding, gives us a price-sales ratio of 1.45. So basically the meaning of this ratio is that for every dollar in sales of the firm, the investor that buys the share will have to spend slightly more than $1.45 to buy that share, to buy that fraction of those sales revenues. Generally, if business is healthy, a lower ratio over here means that investors are given a chance to buy shares at a sort of a discount. And of course, these ratios, as I've just mentioned about the PE ratios, both of these ratios can go pretty high, especially around the times of stock market bubbles. And this concludes the third video on ratio analysis. For the other two videos, see the link down in the description. And of course, while you are there, remember to hit that like button. Have a nice day. Bye-bye.